dear students, welcome to you all to this part 3 under National Income Accounting. Let us discuss today the one of the method of measuring national income. It is the product method. When we say the measurement of national income, there are three methods are there. The one is the product method, or which is also called as value added method. The other one is expenditure method, and the third method is income method. Each method we are going to discuss in detail. For today's discussion, I am going to take product method, or it is called value added method. When we say product method, what do you mean by that? You know, we are measuring the national income by way of measuring the value of aggregate goods and services produced in the country, in all the forms, in all the firms, across all the industries. That means the total production of the nation by all the firms belonging to all the industries are aggregated together and taken as national income. Therefore, product method or value added method mean it consider the produced value of goods and services for that particular year from all the industries of the nation. Therefore, why it is called as value added, I will explain later. And what is product method? Actually, the product method calculate the national income by calculating the aggregate value of goods and services produced in the nation by all the firms of all the industries in a year. And we are going to discuss here a simple economy consisting of two firms. That's what I am writing. That will help us understand the method. We are going to select a simple economy. There are only two kinds of producers. You all know what is a firm. Firm is a production unit. Here we are going to take two producers, and we are going to consider these two producers as two firms. Wheat producer or the wheat farmers, they produce wheat, and the other one is the bread makers or the bakers, they produce bread. These two farmers and the bakers will be considered as the two firms. The wheat producers, what they do, what they produce in the firm, it's really agricultural industry is called as farm also. Here in the wheat producers will grow wheat, and they don't need any input other than human labor. That also they may utilize from their family labor, and they sell the part of the product that is so called wheat produced by this agricultural farm to the bakers for money. And what the bakers do? Bakers purchase the wheat from the farmers, and they process and they grinding, and they add to the wheat, and it grinded, and after that it becomes as wheat flour. You know, the wheat flour are more priced than the wheat because it is value added. Wheat grinded in the mill and processed, it become as wheat flour. That is called value added, adding the value in terms of money to the product by processing. It is called value added. And then later what will happen? The wheat flour is again transformed into bread by further food processing measures with the help of bakers. Therefore, bakers add more value for the wheat flour by producing bread. Therefore, the bakers do not need any raw materials other than wheat. Only they buy wheat. After that, they process and they make bread. Therefore, assume total value of wheat the farmers produce is how much? 100 rupees. We assume, it's an assumption as an example. And out of 100 rupees of worth of wheat, what they do? 50 rupees worth of wheat they are selling for bakers. And the bakers have used this amount of wheat completely for producing bread. What is the total product value of bread produced by using this 50 rupees worth of wheat is rupees 200 because of value addition by grinding into wheat flour and converting the wheat flour through food processing measures into bread. its worth came up to 100 rupees now. Now, that is called value addition. Each process we are adding value to the product. And what is the value of total production in the economy? If I ask you what is the value of the total production of the economy, you may say the farmer produced 100 rupees worth of wheat. Farmer produced 100 rupees worth of wheat. Farmer. Plus baker produced 200 rupees worth of bread. Therefore, the total value is, you will say, 300 rupees. But while measuring the national income, we need to consider one fact here. Why? The farmer producing 100 and giving to this baker 50 rupees worth of wheat. After producing this 50 rupees worth of wheat by value addition, he convert into 200 rupees bread. This is wheat. Wheat is rupees 50. Bread is rupees 200. Therefore, how much added here? Only 150 rupees added. Therefore, value added by farmer, it is a firm, no? The firm 1 we will say is equal to rupees 100. And value added by baker is only 150, not 200, because the 50 came from the farmer. Therefore, the total is 250, not 300. I will explain further this concept. Therefore, value aggregate production, a person who doesn't have a knowledge of economy or the accounting, what he will do, he will say the 200 value of production of the bakers and the 100 is value of production of farmers. Therefore, the value of production of this economy is how much? 300. This economy consists of two producers, bakers and the farmers. It is 300, but it is wrong. It is not real. The value aggregate production not 300. Why? We have to consider why it is. What is the value of aggregate production of this economy? Why we say economy? Two producing firms are there. What are the producing two firms here in the simple economy? Wheat farmer and as well as the bread bakers. Bread makers or bakers we will say. Why they are called two firms? The production unit is called as firm. Here wheat also, one farmer also a production unit and the baker also a production unit. They are adding economic value for the products. Here the farmers had produced 100 rupees worth of wheat for which he didn't use any inputs. Because he had own land, own labor, they just produced wheat just worth of 100 rupees without using any other inputs. And therefore, the entire 100 rupees is rightfully contributed by the farmers. Farmer didn't buy anything from anybody. He just produced from his farm rupees worth of 100. That is what the rightfully mean all the contribution goes to the farmer only because he is not going to pay for other people. And therefore, the bakers had to buy 50 rupees worth of wheat from farmer. Therefore, baker has to pay for the farmer only. Therefore, what is that? Rupees 200 worth of bread bakers have produced is not entirely the contribution of the baker. Why? 50 rupees come from the farmer. Therefore, we can't claim saying that the rupees 200 worth is entirely belong to the baker. If we do so, but that 50 rupees we are counting two times. We are counting the worth of 100 rupees include that 50 rupees. 100 rupees worth of contribution by farmers include that 50 rupees already here. And again we are including that as 200 by baker. Then that 50 rupees included here also. That 50 rupees included here also. It will call the double counting error. Double counting error. What this error will do for the national income? It will exaggerate the national income because the 50 rupees included in the farmer's account also. It is here, it included the value of the product of the baker as 200. Therefore, we shouldn't include that. Therefore, what we are going to do here, we are going to deduct it. that 50 rupees. Therefore, value added is actually is what? Total production of the firm, particular firm, maybe a farmer or baker, that firm minus value of intermediate goods used by the firm. You know, farmer didn't use any raw material. We have studied in our last class what is intermediate goods. Intermediate goods are the raw materials or the inputs purchased from some other sources and utilized for further production. As far as farmer is concerned, he didn't purchase anything. But baker is concerned, bread makers, they are purchasing 50 rupees worth of wheat from the farmer. Therefore, the intermediate good. Therefore, there is an intermediate good for the baker. Baker using an intermediate good. What is that intermediate good? Rupees 50. Therefore, when we calculate value added of firm of baker, what we have to do? We have to deduct this 50 rupees. Because value of total production of the baker is 200 minus intermediate good 50. Therefore, value added by the baker is only 150. In this example, value added is 150. I hope you understood, because 200 baker's total product. What is value of production of the baker is 200 and the intermediate good used by the baker is 50. Therefore, the value added by the baker is 150. I hope you understood. Then, aggregate value of goods produced in the simple economy. Value addition is nothing but aggregate value of the goods produced. Therefore, aggregate value of goods produced by the simple economy, I again remind you, simple economy consists of farmers and the bakers. Here, the net contribution by the farmer is 200. Net contribution also is called as value added. Other name for net contribution is value added. Plus rupees 150, this is the value added by baker. Value added by baker. This is value added by farmer. Okay. And therefore, aggregate value of goods produced by the simple economy is 100 value added by farmer plus 150 value added by baker, it is equal to 250. Therefore, value added in this simple economy, E is equal to value added by farmer net contribution and value added by baker, and it is equal to 100 plus 150, it is equal to 250 rupees. I hope you understood. Value added is nothing but income. Value added is nothing but income earned in this simple economy, because we are measuring national income using the product method or value added method. We can say product method or we can say value added method, but here is a conversion process. Wheat into bread is there. Therefore, we are selling value added by producing 100 rupees worth. Farmer is contributing net contribution. Net contribution is equivalent to value added. In the MCQ, they used to ask, what is value added is termed as fill in the blank. Net contribution. Therefore, 100 net contribution by the bakers, 150, therefore this one is 250. And the term that is used to denote net contribution made by a firm is called value added. Therefore, you have to remember net contribution or value added means the same. Then the example, raw materials, which is here, we have already studied in our first video under national income, that is intermediate goods. Here what are the intermediate goods? Only for baker buy 50 rupees worth of wheat from the farmer. Therefore, that purchased rupees worth of 50 rupees worth of wheat is nothing but intermediate goods used by the baker. You understood, I think we have already discussed. Therefore, value added is what? I have told you, value added is value of the production of the firm minus value of intermediate goods used by the firm. Here only baker is using. Here you can see the same value addition of the simple economy is represented in the form of a tabular form, tabulation. You can see farmer is considered as a firm and the baker also is considered as another firm. Here the total production of the farmer is 100 and the total production of the bread is how much? 200. And what is intermediate goods? Value of intermediate goods used by the farmer? 0. He didn't use any inputs. But you use the labor, that also he may use from the human labor, from his family labor. Baker, he purchased from the farmer rupees 50 rupees worth of, rupees 50 rupees worth of, how much? Worth of wheat, rupees 50 rupees worth of wheat. Therefore, what is the value added? Value added, we have seen that total production minus intermediate goods. Therefore, 100 minus 0. 100 minus 0 is 100. Here 200 and minus 50, 150. I hope you understood. Therefore, value added is calculated by 100 here for the farmer and baker. If I say farmer is firm A, baker is firm B, then I can say value addition of total value addition is value added by firm A, or I can write like this, firm A, value addition of firm A, total value addition, firm A plus value addition of firm B. How much? 100 plus value addition A 100 plus value addition B 150. What is the value? 250. I hope you understood. Therefore, GDP. What is GDP? GDP is nothing but national income. NI. National income is equal to, GDP is equal to national income. Income, we will refer it as NI. National income, NI. Therefore, NI or GDP always say GDP, Indian GDP, European GDP, like that, you know, in each country they will say GDP. GDP is gross domestic product. GDP is nothing but gross domestic product, that is value of goods and services produced by the nation, by all the firms, across all the industries during a year. It is called gross domestic product. Therefore, GDP is value added by farmer. Farmer is a firm A, is rupees 100 plus value added by baker is 200, 150, it is 250. Therefore, 100 plus 150 is equal to 250. Next, value added of a firm. What we do value addition, national income. We have already studied in the circular flow of income. Income is earned. Here, what is the income earned? Value added is nothing but income earned. Income earned is distributed among 4 factors of production. We know what is the circular flow of income. We have seen, no, firm and household, they supply factors of production, then firms, goods and services. Again, they spend here and they pay factor payment. Therefore, whatever is earned in the form of value addition, here national income is value added, that is income is distributed in the form of labor, capital, entrepreneurship and land. These are the factors of production. They have to redistribute their income back to the economy in the form of payment for the labor, payment for the capital, payment for the land. What is the payment for the land? Payment for the labor, wage. Payment for the capital, interest. Payment for the entrepreneurship, profit. Payment for the land, payment for the land is rent. Therefore, they are distributing the income earned. Here is the production method. That's about total value added is give us the income, that is GDP. That is distributed in the form of wage, interest, profit and rent. If you add all these things, it will be again equivalent to value addition. And the next one, the value addition is not what? Value added is a flow variable. It's over a period of time. Over a period of time, anything added, it is called flow variable. Therefore, value addition, we are going on from wheat, we change into grind into wheat flour. Then wheat flour is processed again further in another period, it is converted into or transformed into bread. Therefore, it is over a period of time value addition take place. Therefore, value addition take place over a period of time. Therefore, it is called as flow variable. All the variables expressed in terms of money. Yeah, what we do here, GDP is measured or national income measured at market price. If we don't mention MP, it is also still obvious. We measured all these value of products in terms of market price. Otherwise, we will mention it is only not market price, it is factor cost, FC. But if we don't mention anything, you should understand it is at market price only. Then we don't sometimes mention also. It's obvious it is measured values are based on the market prices. And cross value added is equal. What is cross value added? Cross value added, if the value added includes the depreciation, it is called as cross value added. You can see include depreciation, value added, then the measure of value added that we obtain is called as cross value added. Always we interchangeably cross value added, we always say just value added also. We don't mention every time cross value added. If we just say value added in this section, you can observe it means cross value added. When we say cross value added, it automatically includes depreciation. What is depreciation? It's an annual allowance for wear and tear of capital goods. I have explained to you capital goods, machines, tools, buildings, vehicles. When we use for a long time, they are all durable items, durable goods. When we use for a long time again and again for the further production activities, they may get wear and tear. For that we need repair. For that repair, we have to annually allot some cost. It is called as annual allowance. And what is depreciation? Cost of the good over number of years, useful life of that good. For instance, for example, I am taking a machine, 1 lakh worth of machine I am having, and 20 years is the useful life period. 20 years is the useful life period. What you can say? We can write like this, 1 by 20 into original value or the cost, original value or the cost of the item, that is 1 lakh. Therefore, each year what you will do, 120 of that 1 lakh you will allot as annual allowance. That is what depreciation is called. 120 of the 1 lakh, how much? 5,000 will be allotted because 5000. Therefore, this is what depreciation is calculated. Cost of the good divided by number of years. If it is 20 years, we will say 1 by 20 into the cost of the item. If it is 30 years, 1 by 30 into cost of the item, original value is the cost. And depreciation also known as the consumption of fixed capital. In the sums they will do in place of depreciation, they may use the term consumption of fixed capital because fixed capital is only getting wear and tear. Therefore, it's consumed while we utilize for the further production of other products. This particular capital is used up, wear and tear. That is called consumption of fixed capital. Therefore, depreciation also another name, consumption of fixed capital. And net value added. What is net value added? Gross value added minus depreciation. Therefore, you understand net mean from the gross you subtract the depreciation, then you will get net value added. This also always used to come. How do you derive net value added? You derive net value added from the gross value added, subtracting the value of depreciation. And gross value added is equal to what? What is gross value added? The value of the total production minus depreciation. Minus value of intermediate goods. Value of intermediate goods. You can observe here in our previous slide, the value added also we set the same formula, the same equation, value of production, total production minus value of intermediate goods. Therefore, you should remember that sometimes value added, just they will mention, is nothing but gross value added only. In the normal way, when we say value added, it doesn't nothing but gross value added only. Therefore, both the equations are same, value of total production minus value of intermediate goods. And let us say the firm produce 100 rupees worth of goods per year and rupees 20 is the value of intermediate goods and the 10 is the value of capital consumption. What do you mean by value of capital consumption? Here the 10 rupees value of capital consumption is nothing but depreciation. Therefore, how do you calculate gross value added? Gross value added is what? The total production. How much total production? 100. This is the total production. Total production. total production. What is this? Value of intermediate goods. Value of intermediate goods. Value of intermediate goods. Therefore, total production minus value of intermediate goods, what gives you? The gross value added. 100 is total production, and the 2 piece 20 is the value of intermediate goods. Therefore, you will get 80 per year is the gross value added by the firm, of the firm. And then, what is the value of net added? Value of net added, what? Gross value added. Gross value added minus depreciation. What is depreciation here? It is given by, in this term, capital consumption. Capital consumption is nothing but depreciation. Therefore, gross value added we have derived 80. 80 minus 10, it is called 70 per year is the net value added by the firm. And while calculating the value added, we are taking value of production of firm. While calculating the value added, we are taking what we are taking? Production of the firm. And but we say production of the firm. For example, automobile industry, a firm, automobile firm producing 1,000 cars. 1,000 cars per year. But they couldn't sell all the 1,000 cars during that particular year. What they will do, only sale is only 800 for that year. 800 cars. Therefore, what happens? 200 cars unsold. Therefore, unsold stock is how much? 200 for that particular year. 200 cars. Therefore, even though we are taking the production for the calculating the value addition, or we can say indirectly calculating the national income, we are taking the production of the firm. But it is not possible for all the firms to sell all the products in a particular during the year. Therefore, whatever unsold, it is taken as inventory for the next year. I hope you understood. Therefore, in such case, we will have what is that called? Unsold stock at the end of the year. In this example which I mentioned, 1,000 cars produced per year and 800 sold for that particular year and 200 cars unsold. But we will do this unsold stock. We will carry forward to the next coming year. Therefore, the inventory at the beginning of the year for the next coming year will be 200 cars. Unsold stock is called as inventory. Here, change of inventory of a firm during the year is how much? Change of inventory. Total production minus sale of that particular product per that during the year is called change of inventory. How much you are producing, and out of that production for that particular year, how much you are selling in that particular during the year. That difference will give you change of inventory. For example, in my example, 1,000 cars product produced and sale was 800. Therefore, change of inventory during the year how much? 200. Therefore, production of the firm during the year. Therefore, inventory, here we use this sign is called as identity sign. Identity sign. What is the difference between identity sign and the equality sign? You know, identity sign here in the national income we mean 2 plus 2 is equal to 4. Identity sign mean regardless or irrespective of the variables on the left hand side and the right hand side, it always holds good. Always will be truth, real, whatever the sign in the left hand side or whatever the sign on the right hand side. Therefore, 2 plus 2 is 4. But equality sign, 2 into x is equal to 4. You can write, but you can't write 2 into x 4. Because only x is equal to 2 only, this is possible. Therefore, it is not true always. That is what identity sign mean. Irrespective of the variables on the left hand side and the right hand side, it always will be real. It will be applicable. But you can't say 2 into x is 4. Because only x is, if x is only 2 only, it will be 4. Otherwise, never it happens. Therefore, you can't apply here this sign. Only you can apply 2 into equality sign 4. That is the difference between equality sign and identity sign. Here we use identity sign. Here production of the firm, because this side and this side will be equal. Change of inventory is exactly equal to the production of the firm minus sale of the firm during the year. Production of the firm during the year minus sale of the firm during the year. Therefore, value added of the firm is equal to value of production of the firm minus, and then we know what is value added. We have seen already in our calculation in the table. Value addition is nothing but total production of the firm minus value of intermediate goods. Therefore, production of the, from this we can calculate what is the production of the firm. You just keep production of the firm this side and take this minus this side. What do you will derive? Value added plus value of intermediate goods. You can do, what you do? Keep this value added right hand side of the equation and take this minus value of the intermediate good to the left hand side. This minus, when it comes to the left hand side, what will change it as? Plus. Therefore, production of the firm is nothing but value added. This, we are taking this minus value of intermediate goods to the left hand side of the equation. Therefore, it will become minus will become plus. Therefore, what you will do? Value of production is just equal to value added of a firm plus value of intermediate goods used by the firm. Therefore, production of the firm, or we interchangeably use value of production or production. Production is multiplied by price, it will become value of the production. Value of the production of the firm is equal to value added plus value of intermediate goods. How did you derive this equation? From this equation only you derived this equation. From this equation only you derived this equation. Value added is equal to value of production minus value of intermediate goods. Then if you want to calculate how much produced, just keep that side, that right side of the equation, value of production, and take this minus value to the left side of the equation. The minus value, when comes to the left side, it will change into plus sign. Therefore, what you will get? Value of production is equal to value added plus value of intermediate goods. Value added plus. I hope you understood. And change of inventories of a firm during a year. We told, no? We have already explained that. What is it? Change of inventory mean the total production during the year minus sale of that particular product during the year. Therefore, production of the firm during the year minus sale of the firm during the year. Therefore, change of inventory. Therefore, the production we have found out in the previous this one. What is production? We have already calculated. Production is value added plus value of intermediate goods. We are going to substitute this one in the change of inventories equation. Where production of the firm, from this equation we can derive this equation, value added plus value of intermediate goods. What we will do? We will do now substitute change of inventory. We know inventory is nothing but production minus sale. Therefore, production of the firm during the year minus sale, production minus sale, 1000 cars, sold 800 cars. Therefore, change of inventory is 200. Now, what you will do? We have derived the equation. What is production? Production is not value added plus value of intermediate goods. We will substitute this one there, and then we will get an equation. Change of inventory is equal to value production. In place of production, we are going to substitute our value added plus value of intermediate goods minus sale of the firm during the year. I hope you understood. And change of inventory is a flow variable, because when you say that when the sale differ, the change of inventory also will differ over a time of period. Therefore, it is a flow variable. And the calculation of inventories. Now we are going to calculate the inventory using all the equations. Unsold stock is ₹100 at the beginning of a year. Unsold stock is how much? 100 in the beginning of a year. And during the year production is 1000. And during the year sale is how much? 800. Therefore, change in inventory 1000 minus 800 is 200, because unsold is 100 and during the year production is 1000. During the year sale is 800. From these two information, immediately you can say production minus sale will give you what? Change of inventory. That is 200 for the year. And firm's inventory at the beginning is how much? Unsold stock 100. Therefore, what is the inventory at the end of the year? Beginning of the year was 100 during the year unsold stock is 200. Therefore, end of the year inventory is nothing but unsold stock. It is 100 plus 200. It is equal to 300. It is equal to 300. I hope you understood. Inventory is nothing but unsold stock. What is the unsold stock in the beginning of the year? 100. What is the unsold stock during the year? 200. By production was 1000, sales was 800. Therefore, during the year the unsold stock 200. Therefore, 200 plus that 100 is equal to 300. And cross value added. Now, I'm going to time. It is our time to estimate and present an equation for the GDP, that is national income. What is our purpose of this video? Product method of measuring national income. Therefore, cross value added, we mentioned cross value added GVA. GVA. Cross value, we are taking our firm's name is I. Our firm name is I, for instance. Just for an instance, we are just telling as firm I. Cross value added of firm I is denoted by GVAI. GVAI mean, how do you will explain it? Cross value added of firm I. Cross value added of firm I is identity sign. What is it? Cross value added? Cross value added mean cross value of the output produced by that firm during the year. That is firm I. Here we are considering firm I. Therefore, output always we know in economics, output we mention as Q. All the while when I was explaining in this video, I said value added is total production minus intermediate goods. Value of intermediate value total production. What is the other name for total production? Output. We can say production, we can say yield, we can say output, we can say return. Any term we can use. Here we are going to define an equation for GDP. Here we are telling cross value added GVI is equal to cross value of the output produced by the firm I. That is QI. It is denoted by QI. Therefore, production is nothing but output produced. We can say that value added is equal to total production minus value of intermediate goods. Or we can say cross value added is equal to the value of total output produced by the firm, that is firm I, it is QI, minus value of intermediate goods used by the firm, it is denoted by SATI. SATI mean it is nothing but value of intermediate goods produced. Therefore, what is your GVI? Cross value added I is equal to here QI minus SATI. I hope you understood. And change of inventories. What is change of inventories of a firm? Production of the firm during the year minus sale of the firm. Production of the firm, you can see how we mention here in the production of the firm. Production of the firm in this equation we describe as cross value of the output produced by the firm IQI. Therefore, we can just substitute that one, or we can, from this equation we can derive what is production of the equation. This is production of the equation, change of inventories, right hand side production of the firm minus sale. You take the minus sale to the left hand side of the equation. What will happen? It will become plus sale of the year. Therefore, production of the firm, just keep it right hand side. Then the production of the firm is what? Sale of the firm plus change of inventories of the firm during the year. Just shift from right side to left side. This minus sale, what I am going to do the next step, you take the minus sale to the left side. The minus sale will become, when it becomes to the left side, when it comes to the left side, it will become plus sale. Therefore, what is your production of the firm will be? Sale of the firm during the year plus change of inventories of a firm during the year will be equivalent to production of the during the year, that mentioned by identity sign. Therefore, GVI is equal to value of sales by the firm VI plus value of change of the inventory AI minus value of intermediate goods used by the firm. How did you get? You got this equation from here. Change of inventory, change of inventory is equal to production of the firm, production of firm minus sale. We always use here identity sign. sale of the firm. Sale of the firm. Now, what I am going to see, I want to derive the equation for production of the firm. Therefore, production of the firm, what I am going to do? I will take this minus, I will just keep production of the firm only one side, and I will take this one to the left side. What do you do? This sale will become plus. Therefore, I will write sale of the firm plus change of inventory. Therefore, sale of firm we denote by VI, change of inventory we will by AI, and therefore what I will do in our GVA is what? GVA is production minus sale, production minus value of production minus value of intermediate goods, that is Sathya, value of intermediate goods, Sathya. What I will do, GVA, for the value of production, what I will substitute? This equation, sale of firm VI plus change of inventory AI. That is what it is happening here. Value of sale of firm plus VI plus value of change of inventory AI minus value of intermediate good. That is Sathya. I hope you understood. How would I derive this cross value added equation for the firm I? From our original equation, I derived this equation. Change of inventory, production of firm minus sale of the firm. Then I will see what is then production of the firm. Just take this minus sale this side, then it will come sale of firm plus change of inventory is equal to production of firm. But our GVA is what? Value of production minus value of intermediate good. Therefore, value of production, I will substitute the value of production with this variables. What is value of production? Value of sale by the firm BI plus change of inventory, value of change of inventory AI, then this minus is there like that only. Only production I have substituted this equation, this production substituted by these variables. Therefore, the remaining variable is value of intermediate goods used by the Sathya. I hope you are very clear. Therefore, net value added is what? Net value added of firm I is cross value added of firm I minus depreciation of firm I. That is, depreciation of firm I is denoted by DI. Therefore, value added of the firm I is nothing but GVI minus DI. And then cross domestic product. This is nothing but is a concept of national income. GDP is a concept of national income. We express national income in terms of GDP. We express the national income in terms of GDP. Therefore, if we sum the cross value added of all the firms across all the industries in the nation during a year, it will be added up to GDP. Therefore, GDP is nothing but sum the cross value added of all the firms of the economy, that means in the nation by all the industries in a year, is called GDP. That is exactly equal to value of aggregate amount of goods and services. That is what this method is called as product method. Why? We produce goods and services. And then what we do? We calculate the value of goods and services from all the firms across all the industries in the nation in a year. That will be exactly equal to GDP. Understood? That is what this method is called product method, because it takes the value of goods and services produced in a year, that is aggregate value, which aggregates up, sum up, or we can say aggregating. Aggregating value of goods and services, cement industry, textile industry, steel industry, automobile industry, mobile industry, all the industries and all the services, all the professionals, doctors, professors, teachers, all the services is accumulated, aggregated together for the particular year, and value is measured. That is called the GDP. It expresses indirectly national income. That is what this is. National income is expressed in the form of GDP. That is the popular form, GDP. Therefore, economy in a value of aggregate amount of goods and services produced. Therefore, the cross value added is exactly equal to the value of aggregate amount of goods and services produced by the economy in a year. I hope you understood. Such an estimate is called gross domestic product. What gross domestic product says? It says the aggregate value of goods and services produced by all the firms across all the industries of a nation in a year. And for instance, we assume that there are n firms in our economy, n firms, number of firms are n. Then n firms in the economy each assigned a serial number from 1 to n. Assigned 1 to n. Then GDP is exactly the sum total of gross value of all the firms in the economy. Then that means we have firm 1, 2, second firm, third firm, fourth firm, up to in n number of firms we have. Now we have to add the product of value added of one firm, value added of second firm, value added of BA1 plus GBA, we say cross value added of 1 plus cross value added of 2 for second firm, GBA of third firm up to GBA of nth firm. Nth firm may be 700 firms or 1000 firms, any number of firms, n will be that one. Therefore, GDP is equal to GBA1 cross value added by first firm, added by second firm, up to going on up to the nth firm. If you accumulate all the firm, it is called GDP. This addition is denoted by this sign, symbol, it is called summation. Therefore, you can write GDP is nothing but summation of I, refer the firm, I is from one firm to n firm, I to is equal to 1 to n firm is of gross value added of I firms. I may vary between 1 to n. I vary between one firm to n firm. That is what GDP, GBA1. This I is here 1 firm. Here I is 2 firm. Like that it will go here I is equal to n firm. That's what we write summation of I from 1 to n. Add up and you will get GBA of I for all the I firms. Therefore, GDP, this is our final equation for the product method. Product method. Product method. Final equation GDP is GBI, product method. This GBI is equal to GDP is equal to summation of I from 1 to n is added up to GBI. This will give us product method. This is called as product method of measuring national income. Why product method? We are aggregating value of goods and services produced by all the firms across all the industries in the nation in a year. And now you have to attempt all these questions. All are explained in this video. Thank you. Sai Ram to you all.